what you kind of hit on is that innovation is the asset class, right? And so then the question is, well, how do you want to access that? And there's a lot of different ways to do it. There's the public markets with the larger tech companies that have performed quite well until recently, and then there, of course, there's very early stage, all the way up to like angel investing, where you could be writing like $25,000 checks,
Mhm.
and there's everything in between, and that brings up the idea of venture debt as well, which obviously I run a venture debt fund, and the way I think about it is what we're really doing is just providing access to innovation in a safer way. And I want to get your thoughts as an equity investor in terms of how you think about venture debt helping portfolio companies, and then also maybe what the benefits are for some of the LPs in the space.
Yeah, I mean, I think that I mean, venture debt can be a very useful mechanism for companies that have hit the right level of maturity, where the revenue is a little more predictable, where the growth is a little more predictable, um, where it's less or non-dilutive, effectively, ways to bring in capital. And it's often the time to close it is a lot quicker than equity investors. Um, so I think it really can be a useful tool. I've seen it go right a lot more times than I've seen it go wrong for early stage companies. Um, and then I guess from an LP perspective, if people are looking at your fund, a, I would say it's probably a higher floor, lower ceiling way to get exposure into the asset class that, as we were saying, is like the innovation economy. And I mean, I view the same thing as like when we're raising funds, it's I think the highest floor, I think the highest ceiling, lowest floor, like the most variance you're going to get is investing directly into companies. And I've seen that way too many times where a lot of high net worth individuals, especially, have had some level of success, and then they want to dip their toes into technology and have exposure into this asset class, and think the best way to do it is by writing checks into four companies. And when you do that, when you don't have the diversification spread out across a portfolio, or through a fund manager, or through venture debt in a portfolio, you know, that's a surefire way to lose money in venture, and then for you to never, look at the asset class again. So I just in general, I think that, you know, venture debt, putting money into funds, putting money into professionally managed groups is probably a better way to do it than writing checks into three or four or five companies, seeing them go belly up, and then never going into tech investing again.
I couldn't agree more, and that's a message I tell a lot of people. I work with a lot of family offices, and many of them want to do direct deals.
Mm-hmm.
And oftentimes they're very smart, sophisticated. They built businesses that generated hundreds of millions, if not billions of dollars. But I think oftentimes that doesn't necessarily make them experts in individual tech deals outside of their core competency. Like if you built a widget or a company selling widgets, right? So you built a
Yep.
company selling widgets, and you did it better than anybody. You made a ton of money, but now you're going to go pick early stage SaaS deals or fintech deals or AI deals. They don't really have anything in common. And I think to your point, the smarter investors really find better fund managers that will then let them co-invest
Yeah. Yeah.
potentially in certain deals where they have a real affinity or expertise. And so that to me is the model. I mean, that's the model we use here at ARI, where we basically want our LPs to have access to co-invest in certain deals that we're doing, but then they're getting the diversification of the portfolio. And it's funny too, because I work with a lot of pro athletes, and a lot of pro athletes, for whatever reason, they they've got a lot of money, and they see a lot of opportunities because people are calling them all the time because they know they've got money and they've got access. And I think that, one of the saddest things I've seen is just how many pro athletes do direct deals and
Yeah.
wind up with a
Yep.
bunch of zeros. And so I've been working really hard with them to try to get them into funds that are professionally managed that offer them diversification, but then also give them, like we just talked about, the ability to kind of level up and do bigger deals if they have like a real inclination or something they can bring to the table in that, in that particular deal.
Yeah. I mean, like, in all for context, like we're both talking our own book right now, but I do like fundamentally like believe it, right? I mean, I do think that like, and I'm not saying like just do this. I think you're saying it the right way. It's not either or. You can do and, right? You can do both. You can, because to me, it's like, yeah, they might be seeing a lot of deals. You might be seeing a lot of deals as an exited entrepreneur, but you're not really seeing them. You don't have time to diligence, you know, a couple hundred deals a year as somebody who's a professional athlete or an exited entrepreneur. You have other things that's going on, and that's the benefit of like, you know, probably both of us, where I don't have any other distractions, right? I don't invest in real estate. I don't invest in restaurants. I don't own a law firm, right? I get up and the only thing I do is venture, right? So I think the main like one of the dynamics that I always talk about is like one of the things at early stage or for venture investing or even just like investor founder dynamics is like there's so much information asymmetry where it's like the founders have so much information about such a little thing, right? They are the expert. They live and breathe one thing. They get up and the only thing they care about is their business. And for me, it's like I get to see a lot of a little of a lot. Like I get to see, you know, thousands of deals a year. I get to sit on different boards. I get to see how different dynamics play out. And then I get to like collect that knowledge year after year after year after year and apply it, in conversations and in mentorship with the founders that I work with. And that's an advantage that you build over time as a professional investor that you can't build as a kind of as a hobbyist.
Yeah, you're getting a lot more reps in
Right, right, right.
than other folks, and that enables you to see what works and what doesn't, and basically generate more effective pattern recognition, right? Because you can say, okay, I've looked at 1,000 companies and we've invested in X percentage of those companies. Here's what works and here's what doesn't. Like you said earlier, even founders that have had an exit or two and they're on their second or third venture, they're much more effective and efficient in so many ways that first time founders wouldn't even realize, right? Because they've just gotten more reps in. Like once you've built a company and gone through a lot of these kind of middle office, back office
Yeah.
pains, you realize there's a lot there that you can improve upon.
Yeah, I mean
So
the other kind of similar thing to pattern recognition that I talk about is like it's having a prepared mind. It's like, when like we get up on a Saturday or Sunday and we're reading something about the markets or whatever, or some company that got bought, and then we're looking at a deal, a year later and we're tying it together. It's having a prepared mind of being like educated and well informed of different industries that again is really hard to do if you're not doing it every single day.
so related to this conversation, what are some other investment principles that you live by that are, not processes per se, but just kind of big picture items that you think about when you're investing?
Um, well, I would say that I think invest in things that matter. Like one of the things that I often think about is like if this company is successful, so what? And it's like okay, oh, people are gonna have more fun, gambling or uh, you know, this is gonna help businesses sell more cigarettes. And it's just like, okay. But like I do think that, there's so many places that you can invest and there are so many investment opportunities that we all see on a given day. If, and a lot of them are qualified. Like, I'm not even saying they're bad investments, but like, there's a lot of ways to make money. So why don't you make money doing things that actually matter and things that are going to impact people and their quality of life and their well-being and like we have a lot of bets around one way or another kind of tied into aging and demographic shifts. And it's like there's going to be a lot of strains on the healthcare system, on the financial system, even on the workforce population. And if we can alleviate some of those, stresses that are going on or help people live better lives as they're living longer, I mean, that's awesome. That's a great outcome if those businesses are successful. So why don't we do that? Another thing I would just try to live by is like, you know, in just invest in people that you want to work with. Life is too short to work with people that are that you really don't get along with, that are, a-holes that you don't want to deal with. So invest in people that you want to work with, and that you truly enjoy spending time with, because life's too short to do otherwise.
Yeah, I agree with both those points. I love the idea of products that solve a real problem, as opposed to, okay, let's just figure out how to distract people more and gain more of their attention or dig into their wallets without actually providing them benefit. Right. Like,
Hmm.
to me, the problem isn't that we don't spend enough time on apps, right? So somebody says, okay, I've got this app and it's gonna be addictive. Yeah, that'll probably make money because a lot of
Right.
the apps that we're looking at now are pretty low value, but they're addictive. And so, to me, that's actually a detriment to society. And so, to your point, if you can find solutions to real problems, not just what people want, but what people fundamentally need to live a better life, that's a surefire way to find some good opportunities. And then also, like you said, working with really good people. Yeah, I said the other day, I was talking to somebody, I said, I love working with fat people. And they're like, what do you mean? I'm like, well, fair, aligned, and transparent. Fair, aligned, and transparent. Like that's what I want in every
Good.
person I work with. They have to be fat. And that's the truth, right? Because to your point, you can work with so many different types of companies. I mean, there's almost a limitless amount of companies that need capital, and
Yeah.
many of them will be successful, over time. So the question is, how do you want to spend your time? And it's not working with people that are painful. I think about that too, just in terms of like when I give founders advice and they say like, hey, how do I raise capital more efficiently? Like, just be somebody
Mhm.
who's easy to work with. It doesn't mean you need to be the life of the party or the most charismatic person or super likable per se. You just have to be somebody who is easy to work with. Like, don't make things difficult, right? And
Mhm.
to me, that's more important than anything because time is my most valuable asset by far. At this stage of my life, time it really is far and
Yeah.
away the thing that I value the most because you don't get it back, right? And there's a lot of people that want to, waste it essentially. And so, if I'm going to work with somebody, I want to be sure they're very efficient about how they, utilize my time. So I think those
Yeah.
are great
I
points you
agree.
made. Um, and also just to tie up this idea about common mistakes that investors make when investing in innovation, any thoughts you have in terms of, and this ties into some of the bubbles we've seen recently or historically. If you're an investor and you want to get involved in innovation because that's what's creating value, but you want to do it in a safer way, or you want to do it in a way that just offers better risk adjusted potential returns, what are some things that you would say to them?
Um, Well, I guess I mean from I think we already hit on from like individuals not having diversification, things like that. I guess from like other VCs that I talk to, to me like one of the more common mistakes that we make is not being risky enough. And at the end of the day, like we are asset managers that are, you know, if you truly have alignment with your LPs, in reality, most VCs are hired by their LPs to give them exposure into very high risk, high reward, you know, portfolio return movers, like things that can actually really move the needle on the returns of their portfolio. And so therefore, I think that a lot of VCs need to seek more risk and the potential for more outlier returns that can drive those kind of returns all the way back to their LPs, that really moves the needle for them, for their endowment, for their foundation, for their pension fund. Um, and so I think one of the ways that materializes is like a lot of VCs tend to invest almost where the puck is or where the conversation is rather than, potentially where it's going. And obviously you can look like a complete idiot if you do that poorly. And, I don't think a lot of, going back again to the point of people don't want to build in public. Now VCs, a lot of their track records are public, a lot of their portfolios are public. So a lot of their failures will be public. And so maybe that's why some VCs have strayed further away from risk and potentially seeking these, crazy outlier kind of returns, at least the ones that I've, a lot of the ones I've interacted with. Like one, not to go on like a tangent, but like one way about the like one framework for this is like people look at like a lot of VCs, or they'll write something and talk about like total addressable market or something like that. And like I think more importantly, the best companies challenge that framework of like looking at a Tam Sam Som or whatever, and you know, some new VC or someone who's, not having those outlier returns is really rigidly looking and evaluating at investment opportunities through that framework. But the best ones make you rethink what that is. Like, I think the best examples of this are like Uber and Airbnb, where if you did a TAM of Airbnb at the seed stage, you would have passed on it. You would have been like, this is people renting couches in San Francisco. This market can't get that big. And if you actually said they were not just going into homes and vacation homes, and they were going to start going into experiences, they were going to start actually taking share from the entire hospitality and hotel market, that really challenges the framework of what the TAM is. And they also like introduced a whole new class of travelers. Like more people are traveling now because of Airbnb. So not only did they take the TAM from what you thought it was and move it here, they then took it here and expanded they actually grew the TAM of the market. And the same thing with Uber. Like, I mean, remember back like 15 years ago, ordering a taxi, like that was the worst experience. So if you underwrote that to, well, if they capture this share of the taxi market, like you would have passed on it probably, but they actually increased the share of that market, and they actually increased the entire size of the ride hailing market because that experience was so poor, and now it is so good that they've actually brought more people into that market. And so like those are opportunities to where like I think we have these rigid frameworks, or we have these frameworks for how people look at investment opportunities, and some investors approach it very like rigid and are evaluating opportunities through these frameworks that the best companies challenge and throw in a trash can and completely change what the market is, and can build 50 $100 billion kind of outcomes when they create markets.
Yeah, I love your point about the risk in missing opportunities.
Yeah.
'Cause, there's that, especially with technology and innovation, that's the real risk. The risk is not that you put some money to work and it doesn't materialize. Like that's par for the
Yeah.
course, right? Like that's the median outcome is no return, right? On a lot of these investments. But if you're sitting there afraid of that, then you're going to miss these huge upside opportunities, which to your point create more and more opportunities as they scale. And like that TAM is not static. I think that's what people miss. And first of all, that's all like it's kind of like bullshit economics anyway. It's like, oh, we're going to estimate what this market is. I mean, if you look at some of the consulting numbers in terms of how big the internet was going to be, how big cell phones were going to be, how big, X, Y, or Z was going to be. They all were not even like within orders of magnitude of being close, right? And these are coming from like the McKinseys and BCGs of the world. So, like, let's be realistic here. Like, the idea of TAM doesn't really like mean that much. You just want to make sure that like the scale is in the ballpark, right? Like, you're not going to make a big investment in a company where there's like no scalability. But you
Right.
don't really know if the TAM is, 10 billion or 100 billion or 100 billion or 2 trillion. We have no idea how big some of these markets can be because they
100.
aren't there yet. Like, you're
Right.
literally investing in companies that are creating and shaping the very markets that they're in, right? So
Right.
for
Right.
somebody to estimate the size of a market that doesn't exist, like, it doesn't mean anything really, right?
100%. Yeah. I mean, I think that's like, but that's going back to, I think the main mistake though is people, those are non-obvious things to think about 5, 10 years out. And, if you're betting on Uber at that point, you're kind of betting on the proliferation of the iPhone. And if you were like having supercomputers with in your pockets that have a much better improved GPS, tracking and everything like that. Okay. If if I pulled a McKinsey report, if I was some, VC back in 2011 looking at Uber, and it was like, iPhone sales are going to top that, 5 million a year, then I would go, okay, this is a pass. But I think it does take, even going back to the point earlier, like you do need some of that like ego and confidence to really make these kind of high conviction bets into companies that are gonna run counter to some of the consensus and some of the reporting that you're gonna see.
So speaking of big markets that are hard to estimate the size of, we talked briefly about AI, but let's dig in a little bit more on your thoughts on AI and what the opportunities are, but also what the risks are.
Yeah, I mean, I generally think it's gonna be really hard to invest in kind of directly into AI. I alluded to, there's five or six companies that have raised over $20 billion combined. We're seeing tens of billions of capex spent from, five or six publicly traded companies. So it's just like this arms race that you're seeing within AI. And, we're a seed series A stage investor, we're an emerging manager, it's really hard to compete with a $5 million seed round to go land the best talent, to win enterprise customers away from some of the AI companies if you're, again, trying to directly invest and directly compete with them. I don't think I'm the first to have this thought, but it's like the winners of most of the prior platform shifts were large, well established, well capitalized incumbents. They weren't disruptive startups. Like it's, who won the PC revolution, who won the cloud revolution, um, who won the mobile revolution. It wasn't some completely no-name company. It's Apple, it's Google. Google after it had built an enterprise search business or search business, launched GCP. Amazon after it launched, Amazon launched AWS. It's like these were well capitalized, well funded incumbent companies, and Microsoft, so I don't know how you compete directly with, Microsoft and OpenAI with a few $1 million and a PhD if you're playing their game. To me, we want to invest in companies that are leveraging those very capital intensive innovations and building on top of those leading companies. And we want to understand their AI strategy. We want to understand how they are gaining efficiencies within sales and marketing, how they're gaining efficiencies within product development, how they are leveraging those dollars or how they're leveraging those innovations to make everyone's dollars go further when we invest in those companies.
Yeah, that's my thesis as well. I've been saying that for probably the last year and a half that I think it's going to be the incumbents that win the AI race in a sense, but the real winners are actually going to be the smaller companies that are utilizing AI within their niche to outperform all their competitors because they're basically harnessing
Right.
something built by Apple or Google or Chat GPT, OpenAI, et cetera. And they're then using those tools to operate more efficiently and operate at a scale that would have otherwise been impossible if they weren't using those tools. Like to me, that I mean,
100%.
it's hard to identify who. I mean, you got to really dig in and see like how are they actually utilizing these tools because the tools are emerging so quickly and they're changing so rapidly. So it's not like it's easy to see like, oh, company A is doing it great, but company B has no idea what they're doing. I mean, sometimes it's obvious, but generally speaking, to me, that's going to be where AI is very, very transformative. It's going to be taking small and medium sized businesses and giving them the power to compete with multi-billion dollar businesses and almost from day one because now I mean it's changing so quickly but you can produce more in-house spending like $30 a month on an AI tool than you could have with a team of marketers that
Yeah.
cost you $3 million a year, just 3 or 5 years ago. So that's just one little example, but what you can do with digital marketing now too. I mean, that's transformative.
Yeah.
And so I agree with your thesis. It'll be really interesting to see how investor sentiment shifts because I think we're seeing it already. And you can see it in some of the numbers, like the number of deals that are kind of AI focused are declining. Those checks are it's like
It's
outside of
so
the big
hard to
ones.
tell though. It's like,
Yeah.
I always joke about how like it's impossible to tell. It's like when I do because I write like some of our market analysis to our own investors and things like that. And it's like the main driver of the AI funding, like boom, is the number of companies that just say they're AI. It's like, in like it's like the advanced statistics companies from like the 90s turned into like the business intelligence and analytics in the 2000s, turned into like the big data and cloud computing companies in the 2010s, and now they're all just AI. And it's like, I'd love to find a company that's just changed the categorization of the company, over the last 40 years and like has had very little change in their underlying technology. So
I mean,
really hard to tell.
when people lead with AI, in their
Yeah.
pitch decks, for instance, and this will kind of lead into the next thing I want to talk about, which is funding or tips for getting funded for founders. So whenever I see pitch decks, and it kind of leads with we're using AI to do X, Y, and Z, but the X, Y, Z is the afterthought. It's just about like we're using AI. That kind of just goes right in the delete file, right? Like maybe save for later, but probably never read it, because the reality is, like, going back to your point you made earlier, it's really about, are you solving a fundamental problem, and do you have a business model that works without AI? And then you
Yeah.
put AI into that, you integrate that, and that's fuel for the fire, so to speak. And
Hmm.
so that, in a way, it's actually nice because it's actually easy for me to just say no, right? Because like you, I get hundreds of pitch decks, and it's kind of like, all right, AI for this, delete. AI for that, delete. Oh, here's a good business. Now let me talk to them, and then when I'm talking to them, figure out how they're utilizing AI potentially along with other efficiency tools, right?
Yeah.
So it's actually like a negative screen, which leads into the next question, which is for founders, what are some fundraising tips you have? Because we see stuff all over the internet, all over LinkedIn and other social platforms about how to build a pitch deck, how to contact investors, yada yada yada. Some of it's helpful, most of it's just regurgitated garbage. Uh, Coming from a VC, what would you say are some of the things that you would recommend founders do to get your attention?
Yeah, no, if you just say Gen AI three times in a closet, I just show up with a blank check. Um,
Or you say Web 3.0, that's the other thing that just goes delete.
Yeah. No, I mean, I look, I think I said it earlier. It's like, we get a bunch of these cold emails. It's like that most of them go into the trash. I mean, I'll be honest, like we have done investments through cold emails and cold outreach. It's extremely rare. But yeah, these are long-term relationships that are usually 5 to 10 years, and it's always better to have somebody refer you in. So, I mean, the like pure like or kind of the tactical way to approach this, I always recommend for founders to like build their dream investor list, and even founders like once we've invested at the seed stage, this is the same thing I tell them, build your dream investor list or like go find companies that are similar to yours. Who did they raise from? Build a wish list for investors. Share those with everybody in your network. Have people assign themselves who's going to intro you to who, and hold them accountable. And I mean, to me, like if we're investing at the seed stage, I should be able to make 10 to 20 at least like warm introductions into VCs that I know at the Series A, Series B stage that will look at the company. And if I hope that those VCs, since if it's coming from me, know that like, hey, I can vouch for this company. Like, this is a founder I really trust. Um, and would speak highly of. And to me, it's like if you can get it from a VC, that's fine. If you can get it from a founder, that's even better. Like if you can get it from a founder that's in the VC's portfolio that will refer you in, that's going to go, that's going to go very far to get you at least a first meeting. And then from there, it's about fit. Um, the other points like uh, I I think we've hit on enough, like, the build in public stuff and being public and being visible and being reachable, and being like actually pleasant to work with. All those things matter. The only thing I don't think we have talked about that I genuinely do believe in is to invest in public speaking. And I do see so many times that founders just aren't able to tell their own story with conviction and in a compelling way. And like it does matter from a VC's perspective because I mean, again, we see a bunch of pitches. It's really helpful to have somebody that's actually like compelling to listen to. But it also matters for your ability to like win over the first customers, for you to convince an employee to take a pay cut to come work for you because their equity is going to be worth more. Like it is really hard to do that if you cannot tell a story. And investing in public speaking, storytelling, taking improv classes, things like that, like really actually help shape a founder and their ability to actually build a company and scale it.
Yeah, that goes with my thought about the charismatic founders that I was making earlier, in the sense
Yeah,
that it's not just about raising capital, it's about attracting resources in general, convincing great employees to join you for less money, selling people on your vision, right? Which is, to your point, all about storytelling, right? And then
100%.
also most important, of course, is then being, fair, aligned, and transparent, pleasant to work with. I just think sometimes it's hard because there's just so many people looking for money, so many startups, and because there's such access to information now, we've seen a lot of life has just become very homogenous, right? Like because we're all looking at the same stuff on the news and social media, reading the same types of stuff, and it's all global now, and it's all real time, and so it's very hard to have differentiated access, and so we wind up having a lot of the same
I don't
ideas.
know. I mean, yeah, I could take the complete counterpoint of that
Well,
is
yeah, let's talk about it. I
go
think it's
go
interesting.
on go on Twitter for 5 minutes. I bet you can find completely opposite sides of the world. Like, I mean, I think a lot of businesses now send you stuff that you already think. Like, you're subscribing to newsletters, so then they'll give you more of the exact same thing. You follow people on Twitter, so they tell you to follow similar people on Twitter, right?
Hmm.
It's like a feedback. I mean, I think a lot of people are getting the same information within the same echo chambers, but
Yes.
there's this like bifurcation of data to where, I mean, I bet you if you had this podcast with somebody who was investing in Silicon Valley, they might have a completely different view of everything that I just said. And they would be absolutely shocked to hear that, opinions from somebody like me who's an emerging manager in Florida. And so I do think that like there's almost these information silos or echo chambers that we've created, maybe not as much from the business world, but certainly in politics and like geopolitical issues for sure.
Yeah, no, I agree with you, and 100%. I guess what I was getting at is in terms of fundraising, there's a lot of the same information that's that's shared on social media. Like if you go on social media, you'll see, at least on again, because the algos know what I'm looking for, or, the
Yeah.
types of stuff I read, I see probably 50 posts a day that are just, here's what Sequoia says about how to build a pitch deck, or, and it's just people then regurgitating that shit over and over and over again, kind of claiming some of it as their own along the way, which is another one of my pet peeves.
Yeah. And it's like the point I just made. Like I read a book. I won't disparage the person, but it was like, extremely West Coast, like completely like, oh, the best way to raise money is to be, we're raising on a safe note. You should only raise on safe notes. Like, be super like, you need to give them a shot clock and say we're closing in 2 weeks. If they don't want to meet you, like screw them, whatever. And it was just like, I mean, it's completely um in conflict of what I believe, but I don't know. It's always good to kind of throw in those because we're all in our own little echo chambers, in my opinion.
No, you're right. I think there's a big difference between even within the VC ecosystem, how founders in Silicon Valley act and the type of information they're getting
Yeah.
versus those in the Southeast United States, for instance. Like to your point, they're very different. And I think also you need to be a different type of actor in each environment to do well. Like the ego of Silicon Valley doesn't resonate in Florida. It's like it's just not going to get anywhere. People are just going to be like, all right, beat it, right? But in certain areas, that is what they're looking for. I mean, I've
Yeah.
lived in New York, Chicago, LA, and Boston, right?
Yep.
Never lived in Silicon Valley, but spent a lot of time there. And so that's each of those cities, it has a very different feel, right? But also how what they expect out of founders, I think is very different too, just because of like the nature of the ecosystem. But I think over time though, I do think that things are getting more equalized across regions because mainly because of the internet and digital age. It's just so much easier to get information. It's kind of like one analogy I use is I think about basketball because I used to play basketball and played in college. And when I was growing up, you didn't really you'd have to go and see people in person. Well, you like hear about this legendary like ball handler like Sham God Wells who became God Sham God or and you had the mix, the N1 mixtapes, right? But that was kind of like the first time that stuff from local environments was shared with the world. Like before then, you would have to like go and travel to Chicago or LA or New York, and each place is very different in terms of their style of basketball. But now that everybody watches the same highlights in real time and they get access to the same type of coaching advice, the play actually has become much more homogenous across the board. Like,
100%. It's not even, it's
yeah.
not just that, but it's like there's like a formula for how to play basketball now.
Hmm.
It's like it's not even like it's like here's exactly how the statistical like analysis has told us that this is the exact way that you should be playing. And yeah, it's created yeah, a lot of similar styles of play,
Well, it's funny because you
which I
had
don't like.
remember you had in baseball you had like was it Billy Bean, and then
Yeah.
you had Daryl Morley with the Houston Rockets and other guys that were data
Yeah.
wonks, right?
Theo Epstein.
Yeah, so you had the data wonks, but then you also had in combination with that the people that weren't necessarily using data, but they were then accessing all these different types of players and moves and styles of play across the board in
Yeah.
real time. And so those two factors converging, like the data science with the transparency, really
Yeah. Yeah.
basically led to like a very, I mean, basically the NBA is so it's yeah, it's a formula now. It's like, all right, we're either going to the rim or we're shooting a three. Nobody shoots mid-range jumpers. Nobody has any like true like style to their game that really like differentiates them in the same
Yep.
way that
Yep.
back
Yep.
in the 80s like they had then.
I'm glad that the conversation brought us into the NBA, the state of the NBA. But yeah, it's like you can look at a box score and be like, how many threes did they shoot? Okay, how many threes did they make? Got it. Okay, they probably won. Yep, they
Yep.
won. And
Yeah,
it's just like, I mean, that's how 90% of games are decided now.
totally. So in the interest of time, we've only got a few more minutes. So the last question of the day is, over the next 3 to 5 years, what are the key themes that investors and founders should be thinking about? Just big innovation themes that are on your mind.
Yeah, I mean, I really do believe in some of the like I guess like Andreessen's calling it the American dynamism thesis, and just in general, like the world is getting smaller, and there's a lot of onshoring of manufacturing and nearshoring of supply chains and critical technologies, and obviously what's going on in the Middle East and China and Russia and Taiwan, like the world is getting extremely complicated, right? And I think that there was a lot of incredible benefits to global trade and globalism, and with a lot of key technologies, especially with the acceleration of AI, it is really scary for continuing to have a lot of the same benefits of global trade. So I think that when we're looking to make investments, back to kind of investing in things that matter, and investing in kind of irrefutable trends, I think we are looking towards a lot of those same, a lot of the industries that are going to be influenced by the world getting smaller. And we have looked into more defense tech, dual use technology. We've been open to more space tech and aerospace. We've been open to more climate tech, advanced manufacturing, warehouse robotics, things like that, because we really do believe that the world is going to get smaller, and I think there's going to be, you know, myriad of investment opportunities that kind of surface from that.
Awesome. Well, Ken, thanks for coming on today. I really appreciate it.
You got it, man. Thanks for having me.
Yeah. And for those that want to reach out to you, is LinkedIn the best way, or are there other ways to reach you?
Yeah, LinkedIn's great.
Awesome. All right. Well, thanks, Ken, and thanks everybody for listening to this episode of the 7 and 7 Show with Zack Ellison. See you next time.